You walked into the same bank you've used for 9 years. You asked about a small business loan. The manager smiled. He said he'd look into it. He never called back. 3 weeks later, your neighbor, same bank, different balance, got a call from a private banker offering him a line of credit he didn't ask for. Same bank, same week, different number. The bank doesn't see a person when you walk in, it sees a number. And that number determines everything. The rate you get, the office you're shown to, whether the manager picks up the phone or lets it go to voicemail. The rules of banking aren't hidden. They're just never explained to the people they hurt the most. This is what the fine print actually means at every level of wealth. At $0 to $25,000, you are a liability. You're sitting at a desk across from someone who has already decided. Your credit score is on the screen. Your account history is on the screen. The overdraft fees you paid last year are on the screen. The bank is not trying to help you borrow money. The bank is trying to protect itself from you. A liability is something that costs money to maintain. You are costing them money. Every transaction you make, the bank processes it. Every check you deposit, they verify it. Every time you call customer service, someone is being paid to listen. You are not generating revenue. You are generating expense. The rates you see advertised in the ones on the billboards and the commercials, those are not for you. Those are for someone else. The rate you actually get, if you get approved at all, carries invisible weight. It's 2, 3, sometimes 4% higher than the advertised rate. Source: Federal Reserve Survey of Consumer Finances, 2022. The difference doesn't sound like much until you do the math. On a $15,000 car loan at 9.5%, instead of 5.5%, you pay an extra $2,147 over 5 years. That money goes into the bank's pocket. That is the price of being a liability. The bank calls this risk-based pricing. What that means in plain language is, you pay more because we think you might not pay us back, and they might be right. But they're also right that the extra 4% doesn't come from a calculator. It comes from a category. You are in the category of people who cost us money to monitor, so we charge you more. You've never heard a banker say this out loud. They don't have to. It's in the contract. Page 7, paragraph 3. After the words about annual percentage rate, there's a phrase about terms varying based on creditworthiness. Creditworthiness is the banker's word for your number. Your number determines your price. At $50,000 to $100,000, you are a product. Something changes at $50,000 in annual income. You're no longer a liability. You're a product. The bank has stopped trying to protect itself from you. The bank has started trying to sell you things. You get a letter in the mail, a credit card offer, not the basic card, a card with benefits, cash back on groceries, points on travel, an introductory rate of 0% for 12 months. The bank is not offering you this because you asked. The bank is offering you this because you are now profitable to the bank if you use it. And they know you will use it. You are a product because you have steady income, you have a job, you have a paycheck that arrives on the same day every month. The bank knows this. The bank's algorithm knows this. The bank's algorithm also knows that people at your income level carry a balance on their credit cards. 47% of Americans with income between $50,000 and $100,000 carry a credit card balance month to month. Source: Federal Reserve Report on the Economic Well-Being of U.S. Households 2023. When you carry a balance, you pay interest. When you pay interest, the bank makes money. This is the moment when the bank stops seeing you as someone to avoid and starts seeing you as someone to cultivate. You get a personal banker assigned to your account. Not a relationship manager, not yet. A personal banker? The personal banker's job is to know your financial habits well enough to sell you the next product before you know you need it. You refinance your car at a lower rate. That's real. You save money. But while you're in the office, the banker mentions that you might want to think about a home equity line of credit, just something to have in your back pocket for emergencies. The rate is locked in now, it'll be higher later, you don't need it today, but you might need it tomorrow. You sign the papers. You now have access to $50,000 you didn't have yesterday. The bank now has a second hook in your financial life. This is not predatory in the way people usually mean that word. The rates are competitive, the terms are clear, but the strategy is deliberate. The bank is not trying to trap you. The bank is trying to make you dependent on the bank's products, and it works. By the time you reach this income level, you have a checking account, a savings account, a credit card, possibly a car loan, and now a home equity line of credit. You have 6 different relationships with the same institution. If one of those relationships goes wrong, you don't just lose that product, you lose all of them. The bank knows this, the bank counts on this. At $250,000 to $500,000, you are a client. The office changed. You're not in the main branch anymore. You're in a private banking suite on the 3rd floor. The carpet is thicker, the lighting is softer, the person across from you has a title you've never heard before. Wealth advisor, private banking officer, relationship manager. The title changes between banks, but the role is the same. This person's entire job is to understand your money and make sure it stays at this bank. At this level, you are no longer a product. You are a client. A client is someone the bank wants to keep. A client is someone the bank is afraid of losing. Because if you leave, you don't just take your checking account. You take your mortgage, your investment accounts, your business banking, your wife's accounts, possibly your children's college savings plans. You take $500,000 in relationships. The bank's behavior changes completely. The rate on your mortgage is not the advertised rate. It's better. The bank negotiated it down for you without you asking. The fees that other people pay, the wire transfer fees, the account maintenance fees, the overdraft fees, those are waived for you. Not because the bank is generous, because the bank has calculated that keeping you costs less than the revenue you generate. Your wealth advisor calls you, not because you called first. Because the advisor is paid to call you. The advisor has a list of clients. The advisor is responsible for making sure you're satisfied. The advisor is also responsible for growing your assets under management. If you have $500,000 in investments at this bank, and the bank charges 0.50% annually to manage those assets, the bank makes $2,500 a year on your account. That's just the management fee. That doesn't include the commissions on trades, the fees on transactions, the interest on any lending products you use. For the first time, the bank is treating you like you matter. Not because you're a good person, because you're profitable. You get invited to events, private events, a dinner with a tax attorney, a seminar on estate planning, a golf outing with other clients and bank executives. These events are not free. The bank is paying for them. The bank is paying because these events create loyalty. They create the feeling that the bank is on your side, that the bank understands your problems, that the bank has resources other banks don't have. And it's partially true. At this level, the bank does have resources. The bank has tax specialists. The bank has estate planning attorneys. The bank has investment strategists. These people exist because clients at your level need them. And the bank knows that if you solve your tax problem at this bank, you're not going to move your money to another bank to solve your next problem. At 1 million to 5 million, you are a relationship. The word changes. You're not a client anymore. You're a relationship. Your relationship manager has a team now. There's a tax specialist, there's an investment strategist, there's a credit officer, there's an estate planning coordinator. None of these people report to you. All of them report to your relationship manager. Your relationship manager reports to the private banking director. The private banking director reports to the executive vice president of wealth management. You have a phone number that goes directly to your relationship manager's desk. Not a general line, not a call center, a direct line. When you call that number, a human being picks up, not a machine, not a menu, a human being who knows your name and knows your account. The bank is no longer selling you products, the bank is solving your problems. You have a tax problem. Your relationship manager connects you with a tax attorney who specializes in high net worth clients. The attorney charges $500 an hour. The bank doesn't charge you for the introduction. The bank charges you nothing. The bank pays the attorney a referral fee. The attorney sends the referral fee to the bank. You never see this transaction. You never know it happened. But the bank just made money by solving your problem. This is the moment when the bank stops competing on price and starts competing on access. You don't care about the interest rate on your mortgage anymore. You care about whether the bank can structure your real estate holdings in a way that minimizes your tax liability. You care about whether the bank can help you set up a charitable trust. You care about whether the bank understands your business and can provide financing that grows with your business. The rates you get are not negotiable because there is no rate. Your mortgage is structured as a portfolio loan, which means the bank holds it instead of selling it. The terms are customized. The rate is based on the total relationship, not on the individual loan. If you have $3 million in assets at the bank and you want to borrow $500,000 for a real estate investment, the bank doesn't care about the rate on that loan. The bank cares about keeping the $3 million. You have access to investment products that don't exist for other people. Private equity funds, hedge funds, structured products, alternative investments. These products have minimum investments of $100,000, $250,000, sometimes $1 million. You can access them because your relationship manager has access to them. Your relationship manager has access to them because you have $3 million in assets. For the first time, the bank is not trying to make money off you. The bank is trying to make money with you. The distinction matters. When the bank makes money off you, the bank's interests are separate from your interests. When the bank makes money with you, the bank's interests are aligned with your interests. If your money grows, the bank's fees grow. If your money shrinks, the bank's fees shrink. At $5 million to $10 million, they call you first. The phone rings. You don't recognize the number. You almost don't answer, but you do. The voice on the other end says your name like they've known you for years. They haven't. They've known about you for years. This is a senior vice president of private banking at a different bank. They're calling because they know how much money you have. They know where it's invested. They know that you might be frustrated with your current bank's performance. They know that if they can get 10% of your assets, that's $500,000 in assets under management. This is the moment when you stop choosing the bank. The banks start choosing you. At this level, the bank doesn't advertise to you. The bank doesn't send you letters. The bank doesn't put you on a mailing list. The bank sends a person to your office or your home. The person has a title like Senior Wealth Advisor or Managing Director. The person brings a proposal. The proposal is not generic. The proposal is specific to you. It addresses your specific tax situation. It addresses your specific investment goals. It addresses your specific concerns about market volatility. The bank has done research. The bank knows your age. The bank knows your industry. The bank knows the typical concerns of people in your situation. The bank has built a profile of you without ever meeting you. And the bank is now using that profile to convince you that this bank understands you better than your current bank. The rates you're offered are not rates anymore. They're terms. The terms are negotiable in ways that don't exist at lower levels. You want a $5 million line of credit at a rate that floats with the prime rate minus 50 basis points? The bank will do it. You want the bank to waive all fees for the first year and then charge a flat annual fee instead of per transaction fees? The bank will do it. You want the bank to structure a loan so that you don't have to make payments for 2 years? The bank will do it. The bank will do all of this because the bank is no longer thinking about you as a single customer. The bank is thinking about you as a gateway to other customers like you. If you're satisfied with this bank, you tell other people in your income bracket about this bank. Those people call the bank. The bank gets more $5 million relationships. Each $5 million relationship generates $25,000 to $50,000 in annual fees, depending on the structure. At 10 million and above, you are leverage. The rules change completely. At this level, you're not a customer anymore. You're an institution. The bank doesn't have a relationship manager for you. The bank has a team. The team has a chief investment officer, a tax strategist, an estate planning attorney, a credit officer, a business banker, and an operations manager. All of these people work for you. Not technically. Technically, they work for the bank. But functionally, they work for you. You don't call the bank calls you. Not your relationship manager. The chief investment officer calls you. The chief investment officer tells you about a private equity opportunity. The opportunity is not available to other customers. The opportunity is available because you have $10 million. The opportunity requires a minimum investment of $2 million. The expected return is 15% annually. The risk is moderate. The timeline is 7 years. The bank is offering you this opportunity because if you invest $2 million and the investment returns 15% annually, after 7 years, you'll have $5.5 million. The bank's fee on that growth is 1% annually. The bank will make $55,000 in fees on that single investment. But the bank is not telling you about this opportunity because the bank wants to make $55,000. The bank is telling you about this opportunity because the bank wants to keep your $10 million. If you invest $2 million in the private equity fund and it performs well, you're going to invest more. If it performs well, you're going to tell other people in your income bracket about it. Those people are going to call the bank. The bank is going to get more $10 million relationships. At this level, the bank is not competing on product. The bank is competing on access. Access to deals, access to people, access to information. You have access to investment opportunities that don't exist for people with $5 million. You have access to tax strategies that don't exist for people with $500,000. You have access to credit terms that don't exist for people with $1 million. The interest rate on a $10 million loan is not a rate. It's a conversation. The bank might offer you prime plus 25 basis points. You might counter with prime. The bank might say prime plus 15 basis points, but we waive all fees, and we give you a 2-year interest-only period. You might say prime, 2-year interest only, and we also get a seat on your advisory board so we understand your business better. The bank might say yes. This is the moment when the bank stops thinking about you as a customer and starts thinking about you as leverage. Leverage is the ability to move markets. If you move $10 million from one bank to another bank, the first bank loses $10 million and the second bank gains $10 million. In the banking world, that's a significant move. That move signals something. It signals that the first bank is losing ground. It signals that the second bank is gaining ground. Other customers at your level notice these signals. If you move your money, other people might move their money. The same bank, different doors, you're back in the main branch. The one you've used for 9 years. You asked about a small business loan. The manager smiled. He said he'd look into it. He never called back. 3 weeks later, your neighbor got a call from a private banker. Same bank, same week, different number. The bank didn't change. The bank's behavior didn't change. Your number changed. And when your number changes, everything changes. The rate you get, the office you're shown to. Whether the manager picks up the phone or lets it go to voicemail. The fine print says terms vary based on creditworthiness and account balance. What that actually means is, we have 6 different banks inside this one bank. One bank for people with no money, one bank for people with some money, one bank for people with real money, one bank for people with serious money, one bank for people with institutional money, one bank for people with leverage. You are not in all 6 banks. You are in one bank. The bank you can afford to be in. The bank that corresponds to your number. The only way to move to the next bank is to change your number, and the bank knows exactly what your number needs to be.